Hello, everybody. Thank you for joining us. Welcome to this new edition of the Self Directed IRA Saturday. We have a great presentation and a great speaker today. Um, but before we get started, I want to go through some housekeeping. By the way, my name is Andrea and I'm an IRA specialist at Quest. So let's get started. A little bit on Quest is we are one of the largest self-directed IRA custodian companies in Texas. We have about 20,000 active investor clients across the country, about close to 3 billion in assets under administration. We have about 120, I think, right now employees, and about a third of us are certified IRA service professionals. Right now, we have about 400 million in undirected cash from our clients. So whoever is interested in raising capital, get with us so we can have a chat. Uh, I want to go through this disclaimer that we always do before we get started. Questrust Company does not provide any tax, legal, or investment advice. We do not endorse any products, services, or investments of any type. All information and material are for educational purposes only. So, all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investments. So, let's talk a little bit about for those of you joining for the first time. Self-directed IRA really is it's like any type of IRA. The term self-directed is a marketing term. We use it to differentiate the type of investment we do. There's really no legal distinction between self-directed IRA and any IRA. An IRA is an IRA is an IRA. However, we self-directed, so you right away you'd understand that you'll be investing your IRA in private to look at what example of those private assets. But what some of the benefits of a self-directed IRA and investing in private assets is true diversification, right? You can have eggs in baskets in the public sector, which is where you typically see with invest uh, stocks, bonds, and mutual funds. If you bring it over west, you can have an egg in the bucket of the private asset investing or alternative asset investing, they call it. Other benefits are tax savings, of course. If you invest through an IRA, for example, in real estate, you don't get taxed capital gains tax as you would if you important that investing. You could get involved in companies locally that as long as they're private. Also, a really good one is invest in what you know best and what you feel comfortable doing. And if you're already an investor, then that's even better. Here's some investment choices that we typically see, not limited to, but real estate, single family, buy and hold, foreclosures, commercial properties, private entities, like I said, LLCs, LPs, joint ventures, oil and gas, cryptocurrency. And we also have promissory note, which ties into real estate, but secured, unsecured loans, mortgages, convertible notes, etc. We actually do this every Saturday. We also have a class on Tuesdays as well at noon and Saturdays at noon for educational purposes. So feel free to check those out as well. We do have a national networking happy hour every fourth Wednesday of every month. This is for you to have an opportunity to deal pitch or to network and find your next deal. Or if you're raising capital, this is the one you want to attend to. If you missed the webinar or any of our classes, you can always catch us on YouTube and Facebook since we post them all on there. We do have a networking event every first, second, and third Tuesday in Houston, Austin, and Dallas. So feel free to join us too for those. Those are great opportunities to network as well. And then last but not least, we do have a referral program. If you refer someone, you both get a credit of $25 towards your accounts. Make sure you use this and you could use it a limited amount of times. This is ongoing. So um, get in touch with us if you have any questions. If you would like to explore this further, we have a really good team of about 8 IRA specialists now, ready to answer your questions, ready to help you through your IRA investing process. So go ahead and contact us. Without further ado, though, let's bring Fuquan Bilal here.
Thank you. Can you hear me?
Hi. Yes,
Hi,
I can.
Andrea.
Go
How
ahead.
are you? First, I
Good,
want to
good, good.
thank you guys for having me on the platform. I really appreciate it. It's been a while. I always enjoy coming to speak at Quest Trust Company events. I'm so excited because as you were speaking about the IRAs, I was just thinking of a deal I just exited from a private lending deal I did and made like 13%. And that's kind of um, great, especially in this marketplace that we're in. There's a lot of headwinds in the market. Today, I want to speak about 6 fundamental principles all investors need to know for creating long term success. I really appreciate you guys. Someone said I might need him to show. Okay. I really appreciate you guys attending. I know it's Saturday, and I promise I won't keep you guys long, but promise I'll be here to add some value. Can you guys see my screen, my presentation screen?
No,
Not yet. Okay, let me see if I
no,
can share it.
not yet.
1 second. Let me see. Present. Share screen. Now can you see it?
Yes.
Okay, awesome. Great. So, 6 fundamental principles all investors need to know for creating long term success. So, for those of you who may not know who I am, my name is Fuquan Bilal. I'm the CEO and fund manager of NNG Capital Fund. We invest strictly in alternative assets, and those assets are multifamily apartment buildings for rental income, some fix and flips, specifically in New Jersey, the northern part of Jersey, where I've been investing for the last 24 years. And my favorite investment asset class is notes, institutional notes, especially first mortgages, low balance first mortgages, and some seconds. So I started in '99, jumped out the window and grew wings, flying down, falling down, actually, as Les Brown say, and was doing a lot of fix and flips and had the opportunity, as a young kid to make a lot of money, but was taught a very valuable lesson when the market crashed in 2008. I'm pretty sure you guys heard hundreds of thousands of 2008 stories. For me, the most valuable lesson that I learned was cash flow is king. You probably heard that before already, but for me, it was a major reset because I was really doing a lot of transactional real estate, just flips, made a lot of money and lost a lot of money as well. And then I began my note journey after picking up my face a few years and getting back on my feet, uh, learning how to invest in notes. And I love it. I think it's the best investment strategy in the universe because it allows you to do business from a laptop cell phone. It allows you to help people, keep them in their home, and you just become the true blue lender, get that mailbox money. But I knew that we were in a market that were had a lot of tailwinds. The wind was in our back. And as we started to get closer to 2017, 2019, I wanted to build a model that had a little bit more flexibility, that played a little bit more as a buffer, a hedge against market uncertainty. So I began to diversify a little bit more, just using the skills and the resources that I already had. And also during that time between 2010 and 2019, started to attend events like Quest Trust Company events and other masterminds. Because before then, I was just a lone soldier, right? I knew it all. I had all the answers, the smartest one in the room. Being a part of groups like this, coming on these calls on the weekend and investing your time, probably especially in this time in the market, is the most valuable thing you can do, right? You want to align yourself with people who have a track record, who have experience, people who actually are not just educators, people who are actually in the field, still doing the business today, people who have the scars on their back. Those are the people who have the most experience. Those are the people that I put myself around in high level masterminds, people who I can learn from. So Today, basically, well, let me just tell you our purpose statement. So for me, from where I grew up at, it gave me the feeling of importance investing in real estate, because I was able what gave me that feeling of importance is being able to go back to the communities, revitalize the area, put the properties back on a tax roll, give the residents a better place to live. I'm from North New Jersey, so it's really pretty rough area. Single parents, Section 8, welfare, you name it. So I know there's good people in those areas. And one of the things that really made me excited was being able to go back to the community where I came from, revitalize those properties, good quality work, and make the residents happy, as well as, derive some cash flow from that. So it was a win-win situation. Also, when I got into the note business in 2010, 2011, that really was a really good feeling to give the homeowners a reprieve and just collect the cash flow and help that person stay in the house versus taking the property away from them. Our model was, if we foreclose, we fail. So community mindedness, financial viability, and providing win-win solutions is what drives our success. Right now, our model, as I explained to you, is fix and flips just in New Jersey. um, it's been a big transition. I've seen investing in low income areas all the way up to maybe 3 years ago, when we had COVID, and we started to see, especially with our rental portfolio, because it's a tenant friendly state, a lot of tenants playing the system. So now our model doesn't really consist of any rentals in New Jersey. We just focus on fix and flips in the Northern Jersey area because we're still closer to the city. There's still people migrating from New York that's looking for quality homes. And we kind of divested that rental portfolio and, built the war chest and took that capital and started buying multifamily properties down in the Southeast. And this is probably by far the best move I think I've made in a pivot. And it started over 3 years ago. So grateful for that, because multifamily rental income plays as a inflation. It helps you beat inflation, right? So having these different multiple strategies, whether you're doing private lending, whether you're in the syndication, or you have some note investments, mineral rights, or deed interest, it's really going to be good in this marketplace because it's unpredictable, right? So I am so happy today that I just don't have one type of strategy, because interest rates have increased and fix and flips have slowed down. So now, by me having some rentals in my portfolio, primarily larger buildings, kind of helps me stay afloat. And this is just an orange where we own notes across the US, kind of diversified some non-judicial, judicial states. And these are owner occupied notes. And the whole benefit of that is risk mitigation, right? Being diversified, definitely, especially in this marketplace where we have headwinds and is unpredictable, uh, definitely helps plays as a buffer hedge against market uncertainty. So one of the first things that I want to talk about of the six is patience. So there's a lot of idle capital. I just saw that it's 400 million of undeployed capital that you guys have in your retirement accounts over at Quest. So being patient is very important because everybody's waiting for the opportunity to come. But at the same time, you have to be able to determine which investments makes the most sense when you put them against your portfolio. But patience, this is the largest determining factor, whether you have success or failure, especially in this marketplace. There's a lot of shiny objects where people are promising high double-digit returns, and if you've been sitting on the sideline, sometimes you may become desperate. But staying resilient and having that patience, if you find something that makes sense, I've often, because of the circles that I'm in, find deals that are good income deals is what I'm kind of focusing on now. Before, a lot of people in my circle was focusing on growth. Now people are focusing on things that um, maybe some deeded interest, maybe some private lending, but things that are income driven. So just try to have as much patience as possible. Another one is risk margin, right? Limit how much a mistake. We should limit how much a mistake cost. Might cost if we are wrong. right? I've been wrong several times through my 24-year journey, and risk margin, I think, is very, very important. You want to, you know, not overanalyze a deal. You don't want to sit and look at a deal 20 different ways, because you're going to get gut feeling or certain things. But value investing is very important. Merit based investing is important. The person, the individual that you are investing with is more important than anything in this market, right? Again, I mentioned earlier in the presentation, the person that have that track record, that have those war scars, the person that's been through two market cycles. It's very difficult when you have someone who's just started and been in the business for 3 years, and they're promising you high returns or great profits, and they haven't really experienced the market like we're in now. So you just want to be mindful of that. And risk margin is definitely one of those fundamentals that you want to keep a close eye on. So limit how much a mistake may cost should we be wrong. That's what we want to do. And this actually probably should have been first, right? So what are your investment goals when it comes to your portfolio, right? So you want to eliminate as many headwinds as possible. So investment choices should be made based on the intended goals of your portfolio, and not based on the over underperformance of market benchmarks. So eliminate as many headwinds as possible. Creating efficiency in your model, it to me trumps everything. What we've been doing is trying to continuously figure out a way that we can cut costs, add more efficiency. Now that it's a slow period, and things are not trading at as a velocity as it was before. Use this time to create more efficiency in your model, right? Maybe you have to fish in a different pond. Maybe what you were investing in is not what's happening now. As I mentioned earlier, flip slow down in some markets, right? So things tend to happen from the west to the Midwest and then over to the east. So whatever marketplace that you guys are in, just try to make goals based on what your portfolio currently consists of. Liquidate what you can liquidate now, right? Try to get as much liquidity as you can, because those opportunities are coming in. And I know some of you guys are already seeing a lot of opportunities. As I mentioned, I'm in a mastermind group with several high level investors. Some areas are faster growing as far as opportunities coming, foreclosures, off market deals, and others. Some are still slow. So, really, just try to make a goal based on your current portfolio or the direction you want to go, and go deep instead of wide. So, that's something that you want to be mindful of, and having that flexibility, right? We were just talking about diversity. Really, you don't want to be confined to a predetermined investment allocation, right? You want to have the freedom to pick solely based on merit. Merit based investing is really, to me, the most critical thing you should focus on during this time, right? The people who you're investing with, those capital partners, those sponsors, fund managers, or just people who you are doing private lending deals. If something go wrong, is that person going to be able to be honest and transparent to speak to those challenges? And do they have the liquidity to make it right? Do they have the assets to liquidate to make it right? Right. So do they have the experience, especially in this marketplace, to know how to navigate the narrows? So you definitely want to be extra careful on investments that you are investing in, and people who you are investing with. At the beginning of the call, I was excited. I spoke about a deal I just exited at 13%. This was something that was 2 years, and it was actually maturity date came up on a private lending deal I did, and the investor had said, "Hey, do you want to run it back? I have another deal, and same terms." And I'm like, "Oh no, I'm kind of calling in some dollars to get as much liquidity as I can, and invest in things that I have more control over, versus having it out there. Now, this particular investor didn't do anything wrong. It was just a feeling that I had, especially the time in the marketplace. I said, you know what, I can run it back another 2 years, and I know it's not guaranteed, but I chose not to do it because of where we are in the marketplace. So just starting to have the freedom to pick investments solely based on merit is very important. If let me just get to the next one, and then I ask that. So it's tough, right? You have to have humility. That's another fundamental. So especially as I'm looking at a lot of deals that are coming across my table. Um, no deals that are more than ever now in abundance. Multifamily deals. You guys are aware of what's happening in that market where interest rates literally doubled, and now a lot of the sponsors who took floating debt or short-term lending, hoping to um, get those capital expenditures repairs, those capex repairs done in a certain amount of time to increase the occupancy rate to get permanent financing. A lot of those guys didn't meet that window. And a lot of these are off-market deals that are coming across my desk, and I'm excited because you can pick and choose. You don't have to battle against other people, but you just have to have that patience and not be overconfident, and just know that the right deal is going to come. And even with fix and flips, we actually haven't purchased any since the end end of Q3, beginning of Q4 last year, because we're just waiting for more blood in the street, as they say. I believe, I don't have a crystal ball, but I believe somewhere around mid Q3, in the area where I invest in, Northern Jersey, there will be more opportunity because of the houses that need renovation that's coming to the market. The sellers will be a little bit more desperate to sell. So just having that patient and not just trying to buy things because there's inventory out there is important. The same thing with the multifamily. We're preparing back in the same vein I was speaking about earlier about creating efficiency. We're looking at the next, I would say now, 20 months. I was saying at the beginning of the year, it's going to be the next 24 months, somewhere around Q4 2024, where I think things will start to, change again. I can't see interest rates going back down to 2.5%, but who knows? But we're preparing for the next 20 months of what it is now or worse. So trying to get as much cash flow as possible. Right now, shifting our attention and focus to the multifamily sector, where we know we can find deals that have a high occupancy rate, where we can get permanent, keyword, permanent financing, and build that cash flow. At the same time, building loss reserves is important. But just being patient and having humility is really going to go a long way. Also, creating a risk adjusted model. Some of you probably already pivoted and made those moves. On our fix and flips, what we have done is, instead of doing 1 year holding costs, we're doing now 18-month holding costs. We used to build a model in high end areas where we do a lot of flips to 75 LTV. Now we're underwriting those at 60 LTV. Can we still make a profit if our acquisition, renovation, everything is maxed at 60, 65 LTV? What does that look like? What does it look like if we take the ARV and discount it by 15%? Does it still meet that 60, 65% threshold? So really adding those risk adjusted models, planning for long term, creating more efficiency, having patience, having humility, not being arrogant or overconfident would definitely go a long way in this space. I can't see if there's any questions so far. Let me. Oh, somebody said they do Airbnb. I'll Airbnb. Okay. Was that Airbnb, Andrea? Yeah, whatever strategy. If you guys would post also what strategy are you currently doing in this marketplace, and also where you are tuning in from. That would be greatly appreciated. That it give me a sense of an audience and what type of investors that we have on the presentation. Merit, not money. Charlie Munger said, "Intelligent investing is value investing." I spoke about this earlier in the presentation. Merit based investing. Um, this, I think, by far is probably the best point of this presentation. Everything should be based on merit. The people who you're investing with, the investments that you are investing in. Uh, this is the approach that you should take. Uh, if it means that changing your circle, rebuilding the investment community that you're in, the people you're investing with, maybe it's the asset class that you may be used to doing notes or used to doing private lending. Well, private lending deal is the thing that's happening now because it's cash flow, but you may be used to doing one type of investment strategy and that may not be working. So should you sit on the sidelines? Should you try something else? I would definitely look for the people who have experience and track record that you may can partner up with on something, or maybe they can partner with you if you have something that works for them. But merit-based investing is going to take you a long way, especially in this marketplace. So I want to slow down a bit and see if there's any questions. I know I've been speaking for about maybe 20 to 25 minutes. Somebody says, I'm bidding on a non-performing note and not winning any bids. The sellers give me feedback that the note sold for about 85% of UPB. Yeah, it's a really weird space. Uh, so it just depends on where you are in the market. As I mentioned earlier, things slow down in the West. If it's in a non-judicial states, those are still the highest value assets because of the timeline of foreclosure. I don't, and it's just depends on the type of asset and where it's at. So when it comes to, I don't know if that was a one-off note. You said non-performing notes. Okay. When it comes to doing your notes, usually you just want to give right off the bat. What I've been doing is asking if I get a tape come across my desk. I'm not even going to really waste time doing due diligence unless the seller give me some color or whisper price to see if it's in the range where I need it to be, right? So um, the note space, and this is another reason why I started to transition more into back into the fix and flips, because I stayed at notes for a very long time and built mastery. But I just knew as I started seeing the price increase, I don't know if it because it was a lot of education and everybody started getting into it and getting involved, and pricing started to go up. Of course, I started to make a transition because of the price increase. I made a bid on some assets, I want to say maybe 6 months ago, and I was pretty surprised. The same thing, Alfonso, that pricing was crazy, but maybe longer than 6 months ago. This when the market was, I think it was second quarter last year. And I was like, okay, the market is, values are up, so that makes sense. But now I don't think that note sellers want to take a discount because they still believe that those assets are valuable. And again, it depends geographically where it is, where they are. It may just well be, right? If it's especially northeast area where values is still strong. If you want a discount, you need to find pain points, sellers that have pain points, sellers that need to get liquidity. So that's what I would search for when you are attending um, any note events or any IRA events. You kind of want to look for people who's looking to liquidate. I've been fortunate for people who were exiting the note space. They really, it wasn't, as long as they made profit, they wasn't trying to make a big bag. They just liquidated it so they can take that capital and do what they needed to do. So you probably should make that type of individual your avatar and just, search. What else? Anyone else? Thanks for your question, Alfonso. Appreciate it. Any other questions? Where are you guys coming in from? Are you guys, what state? If you want to post your state and what investments? I got Airbnb, I got notes. Where else are you guys investing from? Anyone doing any multifamily lending deals, mineral rights, deeded interest? So you want how you're going to mitigate risk is dealing with experienced operators with a proven track record, having a diversified portfolio, and making sure that communication is effective. Somebody who can give you performance, be accountable, be transparent, and ultimately give you success, which is a optimized daily experience, sustainable over time. So let me just go back again through these, and if it allows me to, my presentation. Oops, I think I just did something wrong. Is my slide still showing? Yes. Okay, great. Trying to back up. I think the risk mitigation slide. Any other questions while I'm trying to? I see your presentation. Not sure if you are transitioning. Yeah, I was trying to transition, but I think it's on the risk mitigation slide, right? Okay, awesome. Okay, so I'm going to open it up for questions now. If you guys have any questions, again, I would love to see what state you're from, what you're investing in, and come with some more questions. So those were the 6 fundamentals. Austin, Texas. All right. I'll be in Dallas in a few months. And what are you investing in? Are you doing lending deals? Are you doing any residential asset living? Okay. Yeah, that's good. That's good. That's definitely something that's value add. Flips. Awesome. Yeah, so I know interest rates are increasing. There's a lot of I love flips. It's very transactional and it's a lot of work. Um, I like it. I've been doing it for 24 years. So to me, if you already have the resources and the processes in place and you build mastery, why not, right? So you don't want to be a jack of all trades and a master of none. I've done that before and fell miserably. As I was telling you my story earlier in 2008, that's exactly, you know, what kind of led me into trouble. Now for me is all real estate, a realtor, current rates for note investing. What are the current rates for note investing? So I'm trying to understand that question. So are you trying to buy performing notes? Uh, or what return are you looking for if you invest in notes? That's the question. I mean, in the lending deal, what's the longest term you want to have? That's a great question in this environment. Kansas City, short term and long term lending deals. Everyone is looking for things that are short term in this market. People that are in my circles want things that are no longer than a year. If you can get it less than that, 6 months, 9 months, that's great. Um, Try not to lock it in for more than that. And that was the reason I was saying earlier that I did not renew the lending deal because it was a 2-year term. And, it had a 10% equity kicker at the end with a nice pref, but I just didn't want to have my capital tied up that long. I wanted something a little bit more short term for my family trust money. So I decided to back out of the deal and do something that was a little bit more short term and local to me, where I have a little bit more control. Because I have a client that has a high interest rate, so I'm wanting to know if a note investors will pick that up. So that's a difficult acquisition to buy a note from a homeowner that a homeowner has if it's not a seller finance note, if it's a big bank note, that's a really tough um, acquisition to make to go directly to that bank for one note. If there is a seller, if it's a seller finance note, then that could be negotiated with the lender who's holding that note if they want to take a discount and get liquidity or assign the note or sell a note. Um, I don't. Their interest rate is based off of, so that's why the rate is probably high because of the borrower's credit profile. Um, Most lenders will, if they're gonna, if it's gonna be more risk, they're gonna want more reward, and this is why the highest interest rate is there. Or if it's a hard money deal, that's just the model because it's a lot of risk involved with that. Texas, two children are here, beginners, awesome. Looking to get in real estate, yes, 18 and 33. This is awesome. I love it when the youth get involved. I have two boys, and I'm so excited that they are involved in the real estate business. I mean, they have their own passion also, but they understand that real estate is something that is essential. So the advice that I would say is don't force them to do it. It's good that they're here watching. Um, Rich Dad Poor Dad. I'm pretty sure you already know about that book. That's a really great book because it talks about the balance sheet, the profit and loss sheet, and it give visual illustrations to make them understand, the difference between, um, how rich people manage things and how the regular working class have assets and expenses. So when they get a visual picture of that, then they will understand having assets is important. And the easiest way to accumulate assets is by investing in real estate. So alternative assets, things that um, would definitely help that balance sheet become stronger and absorb some of those expenses. Awesome, awesome. You guys are great. Okay, thanks for your response. Great presentation. Thank you. I really appreciate it. Follow Irene. My presentation is actually stuck. Let me see if I can present it back again. Slides. Uh, Present. Let me go to escape. Present. Screen share. All right. Let's see if this works. All right, here we go. I wanted to go back on this again on the six fundamentals. So we went over having patience. We talked about that is the largest determining factor that will basically let you know if you're going to have success or failure in this marketplace. We talked about risk margin, limit how much a mistake may cost. Make sure we be wrong. We talked about goals. Investment choices should be made based on intended goals of a portfolio and not based on over underperformance of a market benchmark. Eliminate as many headwinds as possible. We also talked about being flexible, right? Not confined to some predetermined allocation. Have the freedom to pick investments based solely on keyword merit. Humility, right? Don't be arrogant. It can lead to overconfidence. And lastly, we talked about merit-based investing. So I appreciate you guys attending this presentation. I know it's Saturday. I'm here to answer more questions. Let's see. Yes, Victor. Any more questions? Going once, going twice. Hi, Andrew. Oh,
Hello. Thank you so much, Fuquan. That was amazing. Great information, super valuable. We appreciate having you here. Hopefully, we can have you again in the future.
looking
And
forward
everybody
to it.
else, yes. Thanks, everybody else, for joining us. Hope everybody has a great weekend and reach out to us if you have any questions or need anything. So,
Awesome. Well, it
thank
was
you,
a plum
everybody.
pleasing pleasure.
All right. Take care.
All right.